Good morning. I'm Tim Nyland, and today we are discussing the next leg of the inflation debate. I'm going to walk you through the creation of one of my favorite economic charts in Zacks Advisor Tools and show you exactly what I'll be looking at during Q2 2021 earnings season. And guess what? It's not earnings. I think you're really going to enjoy replicating this chart in Zacks Advisor Tools and watching this normalization play out over the next several quarters, hopefully. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you would like to do the kind of analysis you're going to see in this video, then you're going to need to have a Zacks Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Let's go ahead and get started. The first thing we're going to do in Zacks Advisor Tools is go into the charting menu and just create a new fundamental chart. And in the economics pick list, we're literally just going to choose the personal consumption expenditures chart. And you can simply do that by typing in PCE, and you can see basically it's the symbol that St. Louis Fed uses. We pull all of our data from the St. Louis Fed. And the IntelliSense will pick it up and you simply select it. I have a start date here. I just customized the start date, January 1st, 1993. And you can see I've got a single panel layout, and we're going to start by looking at data in raw format, although I never look at PCE type information in raw data format because it literally just looks like a positive slope line up. It is interesting to look at this particular series to just take a look at the magnitude of the shutdown in terms of personal consumption expenditures during COVID. And what I want everyone to see in the next chart, I literally just took this into my 3D paint and just put a visual plot of a regression line up, a least squares fit. And what I want everybody to notice is that the PCE trend remains basically intact or at trend. And this is obviously support for that transitory inflation argument that the Fed is clinging to along with the consensus view. And again, what we're doing here is we're going to build a very, very unique chart, and it's something that you'll be able to look at over the coming quarters. Hopefully that's all it's going to take to get back to some sense of normalized trends in these types of numbers. What we're going to do now is take a look at another series, and this one is another economic series, total business inventory to sales ratio. And you can simply type in total business inventories, or you can just type in IS ratio, begin to type it, IntelliSense will again pick it up and you'll be able to choose it here. And what you're going to want to do here again is just note that we are basically looking at business units, business inventories per unit of sales. So at the peak here during COVID, when COVID first hit and we shut everything down, we literally had 1.7 units of inventories per sale, if you will, is kind of the way I look at this ratio. And when things start to get lean is when we start getting down here around this 1.25. And you can see, again, I love to draw trend lines on my chart to illustrate these points, that we're literally getting back to the lows that we were back in 05 and during the financial crisis and coming out of the financial crisis. And again, a lot of this can be supply side, a lot of it can be demand side. And the interesting thing is, in our case, right now, it's a combination of both. And so now what we need to do to build this chart that we're going to use here over the next several quarters to monitor whether or not this inflationary trend is in fact transitory or not, is we're going to basically put those two series on the same chart. And when you do that in a raw data format, because you're going to basically start out with this chart in raw data, raw value format, you can see that down here in the lower left. The chart is more or less useless. And I always love to make this point because a lot of people throw their hands up in the air at this point and they say, well, the charting facility is either broken or I just don't know how to chart economic data. If you ever have a question about how to look at economic data, you can reach out to me directly. You can reach out to our support staff. We've got CFA candidates, CFA charter holders on our support staff, and we've got team members that have been with us for 10, 20 years that can answer these questions for you. What you have to do, and you'll notice that part of the culprit here is scaling. In other words, that 1.2 on the total business inventories to sales here is literally just a flat line because of the scaling. What you need to do is transform the data. So down here under data formats, just literally click on the radio button for 1 year percent change. And when you do that, this chart will literally just jump to life, and you will see there is some amazing trends and relationships playing out here. You can see this tremendous jump in PCE that we've had. Now, keep in mind that personal consumption expenditures in aggregate is literally just that. It's literally just an aggregate of all of the personal consumption in the United States. The Federal Reserve uses a derivation of that we're actually going to chart here in a minute, and it's the chain-type supply, or I should say chain-type price index, and that 1 year percentage change is basically what they look at to calculate more or less the inflation at the PCE level. And so what you're going to see here is that when we look at this from a 1 year percent change perspective, you can see how dramatic this drawdown in inventories relative to sales really is. And again, I always like to draw on histories and comparisons to histories as an example of the magnitude of what we're looking at. So to do that, what we're going to do is we're going to literally just draw a line here for the Great Recession lows. And when you do that, you'll see that we bottomed out at about a negative 14%, and we're now clocking in at like literally negative 27%. So you consider it a drawdown in inventories, but keep in mind it's also coupled with this massive ramp up in demand. So we've got a supply side and a demand side story colliding here at the same time, which is literally giving it a 2 times magnitude. If you look at this, this is literally 2 times, and a lot of it is being driven obviously because of this demand side is just so tremendous. At the same time, we have these supply side bottlenecks. So in creating a chart like this, we can now utilize this over the next several quarters to see if these values actually begin to normalize themselves out, and if so, what that actually looks like from an inflationary perspective. So we're going to continue building this chart. We're not done yet. We've got some more things to add. Obviously, retail sales is the largest component, I should say consumer spending, one of the largest components to GDP. And a big chunk of that is obviously retail sales. So we look at our next plot point here, which is in regard to the retailers specifically, and this is retail inventories to sales. And again, you just go into your economic pick list and just type in retailers. It'll IntelliSense and show you the data item, where you can type in more or less the ticker symbol. And just simply select it. You're already at a 1 year percent change data format, so it's going to show you the magnitude of that drawdown. Keep in mind, a lot of this is demand side, but we still have this inventory drawdown here, clocking in at about 36%. And you can see the magnitude of that relative to the financial crisis is in excess of 2 times. Okay, so this is an even worse shape, if you will. Worse shape, perhaps from an inventory perspective, perhaps on the demand side, we've even got that much more demand for retail goods, which is driving those inventories down. So again, a supply side story colliding with a demand side story as well. So the next thing we're going to do is we're going to add that really popular Fed measure here, which is that personal consumption expenditures chain-type price index. And again, you can simply start typing it in here, and IntelliSense will pick it up. You can see how my menu options here are building out from my pick list, and everything's obviously being charted. The symbol for this data item is PCEPI, and you can see I have that up here in the caption. And when you do that, what I want you to see, and obviously what the Federal Reserve is looking at, is this level of inflation. So this is basically your 1 year percent change in this price index, which is personal consumption expenditures, the PCE. And you can see that it's clocking in at around 4%. And again, if I draw a trend line, you can see that we're literally sitting here just pre-Great Recession highs. And so now, obviously, the Fed changing its tune, it wants to let inflation run a little bit hot. So what we're going to want to do is just see how these series play out over the next couple quarters. We want to watch for all of these 1 year percent change series to begin normalizing back to this band between 5% and negative 5%. To the extent that happens, we should see pressure come off of this personal consumption expenditures chain-type price index, and this begin to roll over. You can see that this is obviously very much a cyclical type oscillator because it's under such control with the Federal Reserve. They obviously keep a close watch on that number. So extremely important. This chart is extremely valuable, especially when you add to it the recession shading. So I've gone ahead and saved this off here, and I've called it the next leg of inflation debate. And you can save this off on your own, create it. If you have questions, reach out to us. And this will be a chart that will be very interesting to watch play out in real time. It literally gives you the entire supply side, demand side, obviously inventories relative to sales, taking into account both sides of the equation, relative to the change, the 1 year percentage change in that PCE price index that the Federal Reserve watches so closely. Okay. So what I'm going to be watching for with Q2 2021 earnings season is a little bit different this go around. Instead of looking at earnings, obviously I'm going to be watching earnings, revenues, and everything else. But I'm going to be paying particular attention to inventories, right? I'm going to be looking for commentary around inventories relative to sales demand. And the inverse of that is obviously inventory turnover. So you can look at it either way. This is going to be extremely important to make sure that we don't get too much of an inventory drawdown. Obviously, if that ratio of inventories to sales gets down to around 1, if everybody was in a just-in-time inventory scenario where they're literally outsourcing and shipping out everything that sells, that ratio would be 1. The closer we get to 1, obviously the leaner the inventories get, and we don't want to see it get much lower than a 1.25. So the other thing I'm going to be looking at is profit margins. And this is something that we've talked about in the past, but I don't think I've ever shown you a chart on it. And this one in particular is a chart that we maintain as a custom view in the Zacks research system. And if you have trouble finding it, just reach out to us. We'll help you identify it. It's pre-made as a default, so it's already there for you. And it's basically a 1 to 4 panel chart with revenues plotted in the top panel, but we transform that to a 1 year percent change. When you're looking at revenues relative to margins, and you have to look at revenues relative to margins, you should, because this gives you a complete view of an income statement without having to look at the financial statement. I've explained that in the past. If anybody has any questions, feel free to reach out to me. I'm more than happy to go over it again. But the idea here is that this revenue growth, right? We're now turning the corner, and this is for the S&P 500 in aggregate. So this is a bottom-up reconstructed composite of all the members in the S&P 500 market-weighted, and so this represents the market-weighted average company in the S&P 500. We're making a turn in revenue growth. So if the S&P 500 members themselves in aggregate are able to pass along the costs to deliver these goods to the consumers, then we should see these gross margins stay at least flat, maybe even improve for a while, okay, depending upon how much of the cost they're able to actually pass off to consumers. And so we don't want this to slip. So the idea is that this increase in revenues that we're going to expect to continue is going to translate to at least this maintaining its current trajectory at roughly 47%. We don't want it to slip. The other side of this equation is obviously going to be the payroll. We've talked about how the labor shortage and the increase in payroll could end up eroding margins. And that's going to obviously show up in your operating margins here. And what I want everyone to pay particular attention to is that we've got on average about a 2% buffer to where we've topped out in the past. And again, I always like to segment my analysis pre-Great Recession and post-Great Recession. You've heard me discuss this in the past. Look at the last 5 years relative to the last 10 to the last 20. I love to look at multiple economic cycles, but when we're talking about the S&P 500 in terms of operating margins, which is EBIT margin, by the way, what you're seeing here, you're going to want to take a look at this post-Great Recession, and you're going to want to note the cyclicality in operating margin. Okay, this is real, and I do expect a repeat here. So we've got about a 2% buffer, which is great. I mean, this is great for equity valuations. This is more or less an opportunity for us to expand this operating margin. Then we have to look for margins starting to roll over. Okay, at this point, revenue growth might curtail just a little bit. We might get a little bit of a drop in gross margins as we're no longer able to pass those costs off to consumers. And this is why profit margins tend to take a hit. And obviously, this all rolls up to the bottom line, which is net income. And net margin is obviously net income divided by revenues. So the overall health here of the income statement is determined by this net margin number. And I do expect that to actually set some new records here as this revenue number rebounds. But again, we've got a 2% buffer here in operating margins. If this gross margin can stay at least flat, I expect this to rise and this to perhaps set some new highs here. So we're really, really close to that already. So that's what I'm going to be looking for in Q2 2021 earnings season, and it should be interesting. Quick summary. A lesson that was learned that I think is really, really important that absolutely got no press and the media did not talk about whatsoever. This is a statement from Jerome Powell. If you blinked, you missed it. So I have it here. And he stated just on June 16th, during the meeting from his central bank policy meeting, it turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. And boy, was he spot on. And that is what this webinar is all about. Inventories, 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 and obviously profit margins as well. Supply chain recovery, right? We've talked about this in the past. It's going to be uneven. Do not underestimate the semiconductor shortage. This may take years to resolve. Inventories may be impacted for years to come in some cases. I mean, think about everything that is run from semiconductors. Think about all the companies that assemble the electronic boards, that if they're missing one semiconductor chip, they have a complete bottleneck in their supply chain. And then that goes on to the manufacturers of the actual consumer goods or the automobiles, and they can't complete their end products. So they've got inventory shortages. So this whole thing just cascades. The question is, how long is it going to take for these inventories to recover? And in some cases, this is going to take years. Look for signs of normalization across all four of those economic indicators that we just plotted, the 1-year percent change, as a sign that inflation is under control. That's what we want to see. These are the 4 series that you plot to make sure that we do have inflation under control. And you can watch this play out. You can do it in Advisor Tools very easy. That's what we did today. Point number 4 of the summary here, Fed officials have said they expect the current mismatch between supply and demand to be temporary and inflation to recede next year. Boy, that would be great, and that would surely be good for equity valuations as well. The key takeaway here, as an extension of that last thought, is that we got to keep in mind that these prolonged inventory shortages relative to that rising consumer demand, right? That ratio that we were looking at of inventory to sales. Ultimately, this could be a cost push driver that could be associated with that longer term embedded inflation that when coupled with payroll increases and labor shortage, could make inflation more of a long-term phenomenon than transitory. And that's what we've got to be careful of. Because of key takeaway number 2 that I'll touch on now, we have to keep in mind, and we see this every time play out with the value rotation. We know that inflation itself, a certain amount of it is good for equity valuations. Where we get into trouble is when we get excess inflation in the system and the Fed steps in, and it's that response to control the excess inflation that is problematic for equity valuations. Okay, so keep that in mind. One thing I did want to mention very, very briefly is that you've probably seen some information go out recently on the Zacks Focus List equity model portfolio. This is a portfolio of 50 stocks, all of which are poised to outperform the market average. This is maintained by our Director of Research, Shiraz Mian, and he personally selects 50 of Zacks' best long-term recommendations that are most likely to beat the market over the next 12 months. And you can see here on the screen, since 1996, this group has significantly outperformed the S&P 500. So something worth taking a look at. The complete focus list, including comprehensive analyst reports, are available to all Advisor Tools subscribers as long as you've chosen to subscribe to that focus list. To show the value of the research, we're going to give you the latest reports for 2 stocks on the list. And these reports are free. There's absolutely no obligation. And if you want to learn about these 2 stocks that we're picking to outperform, just go ahead and follow the link in the description below in this particular webinar, and we'll get those over to you. So thank you all for attending. That's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you all for watching, and I'll talk to you next week.